Okay, so what I wanted to do this morning was just show you a basic idea on the mathematics behind retirement. Okay, so this is a simple explanation, but it speaks volumes. Let's assume that 50 years ago from today, which would be what year? Today's 2024, so we're talking about 1974. Let's assume in 1974 somebody, you're a young person, like 15 years old, and you inherit $100,000. A lot of money, right? To make it more practical, let's say you inherited $200,000 and you took the first 100 and had a good time with it, and maybe bought and did something you always wanted to do, or whatever it is, and take the other 100, put it in a trust company, and ask them to keep it there until you were 65, so the next 50 years. Okay. Now, for one thing, we know about $100,000 in 1974. It's worth about $700,000 today, inflation adjusted. So having $100,000 in 1974 is like having $700,000 today. A lot of money. I mean, we know we had the Powerball recently, but it's still a lot of money. Now, if you just left it in the S&P, if you just left it in a Treasury bond, and the average Treasury bond, and this is based on real numbers, by the way, that would equal $710,000 today. So you would have kept pace with inflation, which is a good thing. Nothing wrong with it. You wouldn't have lost any purchasing power. In other words, the same amount of goods you could have bought in 1974 will equal what you can buy today. What happens if I invest in the S&P 500? Well, the problem why most people don't want to do that, if they're retired, is that they don't want all that volatility. If you look back to what happened in 2022, people lost significant amounts of money in retirement, maybe when they needed the money. But here, this person doesn't have that issue. They're 15 years old. They have time. They can allow that money to grow, right? They can allow that money to grow, right? But that's why we have this rule of thumb that whatever your age is, that's how much money should be in bonds or in safe investments. So, for instance, if you're 60 years old, 60% of your money should be in bonds, and only 40% of your money should be in solid stocks. I would say solid stocks. So if you're taking chances, it's not the same as buying the S&P 500, which is a large, broad cross-section of the biggest companies in the country, right? The Standard & Poor's 500. So the bottom line is, if I was to invest, the rule of thumb generally in retirement is, as you get older, that age should be the percentage you leave in bonds. So as you're 30, 30% in bonds. If you're 50, half and half. Because you don't want to take that risk, that volatility, that the market goes up and down, and just when you need the money, you have a horrible year. Maybe as bad as the Great Depression, where the markets didn't recover for years. It's possible, and that's the risk you run when you buy companies. But watch what happens with compounding. If I leave my money in the S&P 500 for those 50 years, and it grows to where did the S&P 500 ultimately return? What did it ultimately return? It ultimately returned 12%. That money would be worth $28,900,000. Now, we don't know many people who were able to put away that kind of money at 15 years old and wake up today and earn that 12%. And that's the reason why it's so high. It's not so high because of compounding. Yeah, compounding is the math. Compounding is the solution. Compounding is the mathematical equation. But the reality is, most people are risk averse, and understandably so. They don't want to take the types of risk that are going to cause them a lot of grief and maybe lose everything. But if they were to forget that, and they didn't need the money, and just left it there, and now you see the power of wealth. If you have the kind of wealth where you can put money away and just forget it, or you're building a business where you can put money away and just forget it, or you inherited money in a trust fund and you could just forget it, you could see how money grows. Because you really, over time, with inflation and the growth of earnings, solid companies will return better earnings. With a lot of volatility, no question. And we know that it doesn't necessarily have to be the entire S&P return. Even if you get something in the middle, it's a pretty fancy number. And that's the point of why we have this split. But those numbers are only high because so few people want to take that chance. And when few people want to take a chance, they pay less for a stock and the returns go up. And when more people are risk averse and they pay and they're going to put more money in bonds and less money in stocks, well then those stocks are ultimately, the prices that they pay for what they do own are going to yield lower returns. They're going to pay more. Like, think of it this way. This is the best way to explain it. If you opened up your own hamburger business, you took space out locally, you sourced the burgers, you sourced the Coke, whether it's Sprite or whatever you're going to sell, the French fries, the whole 9 yards, and it succeeds. you're going to earn about 35%, because that's what a good restaurant earns. You're going to earn a 35% profit, which is as good as it gets in business. If you take that same money, if you want to open up a McDonald's, the rate of return is only 12 or 13%. Now, it's not only 12 or 13% because McDonald's gives you less. It's 12 or 13% because people pay so much more for the McDonald's that the competitive price is high enough that for the same business, the return goes down. Because why? Because there's less variance. Because people already know what to expect. Whether you like McDonald's or not, when you pull up, you know what to expect. And because you have that name recognition and that lack of variance in what to expect, as opposed to, well, I don't know what that guy is serving in his own hamburger place, the rates of return go down. So therefore, the rates of return are a function of how much people are willing to pay or the demand for a product. And that is the lesson I wanted to teach you this morning, this brief lesson. Now, generally speaking, most people create a blend of investments that equal right around here. That's what we found historically. They're not going to take this chance over 50 years. It's just, first of all, very impractical that somebody would leave all this money and not touch it for 50 years. Generally speaking, with investments and everything else, and the blend between bonds and stocks, and the fact that we do encourage people to be a little more risk averse so they don't lose everything, they're going to come up with returns here. Now, there are going to be people who are going to study the market, maybe do better, or maybe buy a particular stock and stick with it. I told you the story about this friend of mine who owned this huge pharmacy. His family was, his parents were from Russian Jewish immigrants. They owned a small trucking business in Lower Manhattan years ago. Obviously, this guy was older than me. I'm 65. This guy he's in his 80s, but his parents were immigrants. They had a two truck business down on Delancey Street where was the garment center, which was the garment center for many years, and they ate kosher. But they saw a stock that and there's a reason why I'm saying that. They saw a stock that they thought was interesting, and every time they had extra money at the end of the year from their business, they bought the stock continuously. And when they finally passed to their return or reward, that was a small fortune that their family he was able to open a pharmacy. His sister was a PhD who ran an English department at a major university. They all built off of that. That stock was McDonald's. Now, those are folks that would probably, like my grandparents, wouldn't eat McDonald's if you forced it on them, if you paid them to eat it. But here, they saw value. And that's usually how you make money in the markets, by finding good fundamental ideas and just sticking with it and buying it when you can. So those are generally the returns, if you understand my logic. And if you have any questions, just type them in to the comment box and I'll answer them. So if you assume a 6% rate of return, and now let's look at the average person who doesn't inherit $100,000, but puts away $5,000 for 45 years, from when they're 20 to 65, and earns the average rate of return based on their risk aversion and what they're going to actually earn versus treasuries, because they're going to put some money in fixed income. They're going to probably come out with $1,063,000 if they don't touch that money. And then at 65, if they earn 6% going forward, which is not unreasonable, you do have to pay taxes on the money. So maybe I'm being a little aggressive, but let's use 6% for arguments. Let's even be more conservative. Let's say you can earn right now about 4%, because that's what the Treasury is going to pay you. That's the after tax. You do a little better than what the Treasury pays, right? Then you're going to earn $24,000 a year, right? And the average Social Security is about 2017. That's about average in the country, right? Oh, I'm sorry, 2017 is what you can earn on 6%. 2,800 is the average Social Security. You're going to come out with about $5,000 a year. If that return goes up a bit, which is always harder to go up a bit, because if you go up a bit, it means you got to take a lot more risk, because the marginal benefits in the market are much hard to get. To go when everyone's getting 4. If you want to get 6, you got to take a lot more risk than what you're getting back. And that's why people get hurt in the markets. That's why you see some stocks go ridiculously high, like an Nvidia. Yeah, it's a good company, or Amazon way back when, and then people lost money because they're reaching, because they want to make more in retirement. And when they do that, the only way they can get it, since their incomes can't change, right? You're fixed on your income, is that they take chances in the market, and they overbuy bonds, and they overbuy stocks. So at 6%, you get 8,000, but to get that extra money, you got to take a lot of risk. If you take more normal risk, you're going to get like 5,000. And we know that 5,000 in retirement isn't exactly a king's ransom. I mean, you can assume that you paid off your mortgage. You can assume that, right, that you paid off your mortgage, but you still have real estate taxes. You still have upkeep. You still have transportation. Medicare costs money. So you could see why retirees will generally try to reach for the market if they're not cautious. And that's why you get that volatility in the markets. Because we do know, studies show that most of the investment happens for older people. Even though younger people save their money, your older people have more income to put away, and they more dominate the markets at that point. So this gives you a general example of where retirement money is, right? I mean, you could have earned more and have more Social Security and more here, but it all becomes relative to your lifestyle. Hopefully, that's a good example of why the numbers shake out for retirement, and why the markets move the way they do, and what determines rates of return, or at least theoretically, what would determine rates of return.